Hello and welcome to a CMS Forex Daily Video Recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, August 5th, 2010. Armed with some better than expected fundamental data to start the third quarter, ECB President Trichet was marginally more confident in his press conference following the ECB's decision to keep interest rates at 1%. That rate was appropriate, he said, meaning that officials did not see a need to raise rates soon. He also said that growth, however, is likely to be less buoyant in the second half of the year than it was in the second quarter. The question now is what the next steps will be taken by the ECB, as it is currently supplying unlimited cash to banks in 3-month tenders, which needs to be removed. Trichet did say that its non-standard economic stimulus measures were temporary, and those included credit support and the securities markets program. The ECB is likely to continue assessing the incoming data and may give more information on winding down some of those measures in its meeting next month. The Bank of England, meanwhile, kept its bond stimulus plan in place and left its benchmark interest rate at a record low of 0.5%. A split among officials on the direction of policy widened in the past month as Andrew Sentence argued for higher interest rates to curb inflation, while David Miles insisted the bank should be ready to buy more bonds if needed. Economic growth reached the fastest pace in 4 years in the second quarter, though surveys recently have showed services, manufacturing, and construction have since weakened. So, while some argue that more quantitative easing may be needed, others are saying the economy is strong enough to begin raising rates. We may have to wait till the Bank of England meeting minutes in order to see which camp is gaining more ground. In the third report, we saw U.S. initial claims climb by 19,000 to 479,000 in the week ended July 31st, which is the most since April. Economists had expected the jobless claims figure to decline for this week. Now, we all await tomorrow's very important non-farm payroll report, which is expected to show employers cutting 65,000 jobs in July, the second straight drop in non-farm payrolls. The market has absorbed and priced in a much more pessimistic outlook for the U.S. economy and the Fed potentially reinvigorating its monetary easing. The market continues to presume the Fed will act quickly if its recent economic slowdown becomes too severe, and that is where tomorrow's jobs data may be a turning point. Turning to the euro-dollar pair, we see that it rallied in overnight trading, but after touching yesterday's high near 1.3235, we saw the pair decrease as we had a bout of risk aversion following the U.S. jobless claims data, which cast a darker light on the U.S. economy. If we zoom this pair out somewhat, we see that it has run up against an upward sloping level of support, connecting our lows from June 22nd and June 23rd, which we tested overnight and test again in the New York session. So if we break this level, and we have broken through our 50 period and 100 period moving averages in the 1 hour time frame, that could mean that we could see a sideways consolidation in this pair, perhaps with support at the 1.30 level, if not at the 1.31 level. Taking a look at the pound-dollar pair, we were unable to move above our resistance at 1.5960 in yesterday's session, and in today's trading we consolidated further between 1.5925 and the 1.5820 level. Here too, we are testing our recent uptrend as our support trend line here was tested overnight, and then we actually broke below it briefly in the New York session. We may see further sideways trading prior to tomorrow's non-farm payroll report, and if the jobs data from the U.S. causes there to be further risk aversion in the markets, we may see this pair moving down to test its lows from this week at around 1.57. But if it increases risk appetite and we see equities gaining, then we could see another test of this 1.5960 level in tomorrow's session. Taking a look at the dollar-yen pair, yesterday we had mentioned the 86.50 high as a very important level, as it was a level of support broken into resistance back here from July 16th and July 23rd. We broke below that level in last week's trading, and yesterday our high tested that resistance now, and that resistance held, and we saw overnight the yen strengthen, which is a good signal for the yen strength, while also being a weak signal for the greenback on the back of the weak jobs data. So that gave us an extra leg in today's move in favor of the yen. We have seen some recent volatility in the US dollar Swiss Franc pair. Yesterday we had a strong rally, as we did throughout most of the pairs, in favor of the greenback. But today we saw the Swiss Franc gaining, and it paired most of its losses from yesterday's session, testing the 1.410 level as our low for today. The Swiss National Bank's currency reserves fell for a second month in July, which raised speculation that it's taking advantage of a stronger euro to sell the shared European currency. Currency holdings at the SNB dropped to 219.3 billion francs from 224.9 billion in June. That's the second monthly decline after holdings peaked at 238.8 billion francs in May. The SNB was forced to buy foreign currencies, including the euros, in order to prevent deflation and bolster Swiss exports. After quadrupling its reserves, the SNB said that it was ready to stop purchases, and now it seems to be selling those euros and buying francs, but it may want to be careful not to strengthen the franc too much during this normalization process. If we take a look at the Euro-Swiss franc pair, we had seen that we had a 4-session uptrend in this pair, but in today's trading, we've seen the Swiss franc pair a good amount of those gains, testing the 1.3750 level, a level we broke above in yesterday's session. So we'll see if this move in favor of the Swiss franc lasts, or if this was just a retracement to our most recent moves. Taking a look at the New Zealand dollar, we saw it slumping in the Asian session as we had a release come out from New Zealand showing that the country's jobless rate climbed more than economists had forecasted, a potential spur for the central bank to slow the pace of interest rate increases. We broke our recent short-term support at the 0.73 level, and if we go back, we actually see that this has been a very important level for this pair. And as we can see, today's action broke below a short-term level of support, upward sloping trend line. So this puts some weakness into this pair, but for the most part, we may just continue to consolidate between this 0.72 and 0.74 levels, with a lot depending on how risk appetite and how commodity prices fare following tomorrow's non-farm payroll report and the tone that sets heading into next week. Now we know that the non-farm payroll report will be the main focus tomorrow, but let's see what other releases we get first. Tonight we get some data from Australia, including construction PMI and the RBA monetary policy statement. Overnight, Japan posts its leading indicators. Switzerland posts its unemployment rate. The UK releases manufacturing production and industrial production figures, as well as its producer price index, and Germany posts its industrial production. Tomorrow, we get at 7 a.m. the Canadian employment change and unemployment rate, followed by the non-farm payroll report, the U.S. unemployment rate, as well as wage data. That will be followed up at 10 a.m. by the Canadian IBPMI and at 3 p.m. by U.S. consumer credit figures. And that will wrap up today's daily video recap. For more news, videos, and analysis, please visit our website, cmsfx.com. I want to thank you for watching and wish you great trading.